Well,
thank you for having us, and good morning. Have y'all ever been to Texas? It's a little warmer there, but we've enjoyed being here. For all the diversity on our team, nobody had ever been in Memphis, so this is very exciting for us. And CBI has been an exciting company as well, especially with the acquisition of Shaw. It's been a great challenge to do this analysis. We recommend the company as a buy, and our Texas A&M Corpus Christi team is going to tell you more of those details. But it basically centers around four arguments. One is the sheer size and outlook in the market. The second is the unique synergies between the segments. The third is the diversification the company's been able to achieve. And fourth, the strength and experience in their leadership. We'll go more through the valuation. We valued the stock at $64.98, which was a 52% upside potential from our end-of-year baseline. The first place we see opportunity is in the market. The energy demand globally is forecast to rise 33%, with electricity needs increasing 70% due to emerging markets. The global infrastructure has been valued at $70 trillion worth of spend, and the majority of this in energy infrastructure, of which it's been noted that engineering and construction has the most to gain in the short term. So we see this in the industry forecast, where last year growth was just 3.9%. Out to 2016, we're looking at 30% growth, or a 5% compounded annual growth rate. And CB&I is very well positioned to take advantage of this, especially with the Shaw acquisition. They're very balanced now in their global footprint, and they've got leading positions in two very key segments, in both hydrocarbons and in nuclear. But it's not just their positions in those segments, but the mix of their segments that we also see value in.
Synergy gained from Shaw acquisition have strengthened CB&I competitive advantage, shifting CB&I to a more competitive position in the power and energy infrastructure. Our team trusts this synergy in terms of capabilities and sustainability. From the aspect of capabilities, these acquisitions bring into first, complementary business segment, second, new range of services, and third, increased resources that allow CB&I to strengthen its capabilities as well as capture the opportunities in the power and energy infrastructure industry. From the aspect of sustainability, these acquisitions offer firstly the significant backlog, total $26.6 billion, almost triple CB&I current backlog. Second, new customers, especially for the government sector. And third is the strengthened competitive positioning against its peers. Major players include Bechtel, Fluor, KBR, Jacob Engineering. Looking at the chart, and you see that CB&I had the highest EPS growth and lowest PG ratio, indicating an attractive stock for investors. As for profitability, the highest ROE indicates that CB&I is able to generate more profits than peers. Therefore, it is optimistic that this acquisition would be accretive to CB&I share earnings. With these synergies, CB&I expects to have approximately $115 million increase in revenue. And this synergy even help diversify the macroeconomic risk that Rodney will have elaborate more.
Another reason why we chose a buy for CB&I is the ability to diversify the risk that can come with acquisitions and take advantage of the opportunities. One of the opportunities is going to be in the nuclear industry. Shaw currently has about a $7.2 billion backlog in nuclear with two contracts that they have that stems from two permits, the first two permits issued in the United States since 1978. However, the risk is the fact that the U.S. Court of Appeals has stated that there will be no more permits issued in the United States. CB&I can still take advantage of this because of their steel structures. They can still build the facilities for the solid nuclear waste, the waste that they can't decide on how to dispose of. Another opportunity that CB&I has is going to be green industry. Green industry is continuously growing and getting bigger and bigger. This, though, could hurt the hydrocarbon of CB&I's core business. But through the acquisition of Shaw, they get access to the hydroelectric power and the environmental protection services, giving them a foothold and allowing them to take advantage of the opportunity of the green industry growing. Another opportunity they have is liquid natural gas, LNG. There have been a lot of natural gas resources found within the United States. This has caused natural gas prices to go down, and this has also caused the investment to go up. However, there was a report called a new report stating that it will be a benefit to the U.S. economy if they export gas. This though could cause investment in gas to go down and the gas prices to go up, causing the investment to go down. which could hurt a little bit. However, CB&I can create the specialized storage facilities and the terminals for this liquid natural gas before it's actually exported overseas. CB&I is able to do this through their strong leadership and their strong history with acquisitions, which is what David's going to talk about.
Thank you, Ronnie. CB&I has pursued growth through a strategic acquisition within the last decade. This has permitted the company to expand their portfolio of services and capitalize on the engineering integration. In 2000, they acquired Howe International LLC for $145 million, and in 2003, they acquired A&M-Round hydrocarbons. This led to an increase of EBITDA of 41.2 compound annual growth rate. In 2007, they acquired Lumus Technology, which brought a little bit higher their margins on profitability and led to an increase in EBITDA of 18.3 compound annual growth rate. The last benchmark was in 2012 consensus, and this led to an increase of 15.8 compound annual growth rate. Now, it's important to say that CBI has been very careful with this acquisition. They set up a team of 24 people to do external and external due diligence on this acquisition. This is consistent with the 3 acquisitions that I just talked about. Now, everything that I'm about to tell you is going to happen after the acquisition happens. There's going to be a cost savings, immediate cost savings of $55 million, 115.3 EBITDA increase. Also, CBI is expected to have 50,000 employees, which is the highest in the industry. With the lack of technical expertise, this leads to a competitive advantage in the industry, 3,000 engineers and 1.2 project management. Now, tenure for senior management, for top executives and CEO experience is above industry average. Also, the number of employees is above industry average. The CEO compensation is below industry average, which leads to a good impact in the financials. After doing some technical and fundamental analysis, we have come to the conclusion that this is a strong buy, and JD will talk more about it.
Thank you, David. In calculating the projected cash flows for CB&I, we use a percentage of sales method on the income statement and then use those to derive the free cash flows for the company. CBI is expected, as mentioned earlier, to realize $115.5 million in EBITDA and $55 million in the same from cost savings and revenue synergies from the Shaw acquisition, and we took those into account as well. The 2 main methods we used in our valuation were discounted cash flows and multiples analysis. We believe that these 2 methods most accurately capture the value of CBI post-acquisition. The first method we used was the discounted cash flows method. We believe this captures the history of continued growth and the stability of these 2 companies. We used a growth rate of 7% for CBI, and this was chosen by doing a segment-by-segment analysis of each of the segments of CB&I for the past 3 years, as well as taking guidance from industry analysts. The 3% growth rate for Shaw was done using the same process. In deriving cost of equity, we used a 4.0 risk-free rate, which was a normalized 20-year rate to account for the abnormally low risk rate that we're experiencing now. And we used a risk premium of 5.5% and a beta of 1.65 to arrive at a cost of equity of 13.08%. Putting all of those into our DCF model, that gave us a price of $49.33 using the discounted cash flow method. The second method we used was a multiples analysis using price to earnings ratio. We took a 13.3 price to earnings ratio for CBI and a 20.6 ratio for Shaw, and using a weighted model, we came up to a 16.3 price to earnings ratio for CBI Shaw post-acquisition. Taking into account future earnings, that gave us a final price using this model of $77.01. In calculating our final fair price for CB&I, we used a 60-40 weight. We weighed the price to earnings ratio more to account for the synergies and the optimistic outlook and the fact that the 2 companies will be substantially different than they are now. However, to be conservative and to account for the continued growth, we used 40% from the discounted cash flow method. This gave us a fair value of CBI of $64.98. Pretty much we feel that the positive outlook and the synergies that will be realized from the CBI Shaw post-acquisition, as well as combined with the continued growth of these companies as they were before, warrants a buy recommendation. Simply, the upside potential is greater than any risk that the acquisition or economy might provide, and CBI is worth your attention. Thank you.
Judges, 10 minutes. I'm going to kick off 52% upside from your valuation target of $65. And then, so you used the value from December 28th of $42.62 share price. Do you know what the current share price is and what your upside would be based on the current share price?
It's closed at 51.25 on Friday. It's about 33%.
So you probably want to update your slide or your presentation to show that.
Yes, sir.
Okay. Another quick question, and I asked another team this, so it must be kind of difficult to discern this. Do you have a feel for their exposure to natural gas, nuclear, oil, as far as what their revenues, how exposed their revenues are to those three energy sources?
The pay structure, 40% of the pay structure comes from, 40%, I'm sorry, comes, the revenue from steel structure comes from steel structure, it comes 40%. Now, out of the operating margin comes 45% of it.
The steel structure, is that more natural gas or nuclear focused? Do you know where those end markets are?
It's mostly the hydrocarbons. So I would say that, as it comes to risk as a part of their revenue, their hydrocarbons are almost half of CBI's revenues. So there is substantial risk there. But they are also, as we mentioned,
There's risk from nuclear. I'm sorry to cut. Is that kind of what you think?
And that's half of the backlog that's coming from Shaw is tied up in 2 projects. And so they've got some liabilities with that. They're behind schedule in their contracts. But what we see is that with the CBI methodologies coming in, that most of those root causes are in construction, and they should be able to bring some discipline that helps that get back on track.
Okay. And so with those risks, you probably at least want to touch on some of those risks when you're providing your recommendation. You want to show the investor or your audience that you consider both sides. Exactly.
You said you had a buy. What percentages would it be a strong buy, or where would it be a hold or a sell? Have you thought about that?
We didn't really do strong buy or buy. We did a valuation previously with CBI, assuming the acquisition didn't go through, and we tried to count, what CBI would be without the realized synergies and the additional segments and diversity that Shaw provides. So CBI by itself, we came up with a fair price of around $51. That wasn't included in our report. It was just when we were doing our analysis. So we would probably feel that around between the low 50s would probably be a hold, just especially since that's what the stock is trading at currently.
Most places, if they're going to say it's going to be a 5% or a 10% gain, it's going to be this. A 15% gain is going to be that. You're just going to that would be helpful for the sort of standard. Most of them, if it was a 30 or 50% gain, they say that's a strong buy. Well, if that ain't strong, I don't know what is.
Yeah.
And doing we did the NAIC analysis, and our targets on that put it from about 52 to 60, 60 to 70 is maybe, and then 70 to 77.01 are high multiple as a sell. And so you might ask, why didn't we include that? And honestly, I think with the NAIC, there's so much subjectivity in which numbers you pick and choose that we looked at that to use it as a sanity check against our numbers, but we used our numbers as guidance for the
I'll come right back to that subject to read just a second. You said you used 7% growth rate for CBI and 3% Shaw, and you compared it to sector numbers against others. Do you have any slides or anything to show that information, or how you came? Because that's exactly how I'd want you to do it, but I'd like to see some backup number-wise.
We don't have the data with us. We did use the growth rates, like I did. We said segment by segment. We took we looked at the operating margins of each segment for each company, and back for about 5 years. And then we also looked at Value Line and other market reports to try to just do a sanity check on what we wanted to use our growth rate to.
Now, should you get the chance to move forward, though, that segment by segment battle,
Yes.
pricing it and valuing it is exactly how the rest of the world works.
Okay.
So, the fact that you did that is a differentiation from most of the other teams. And to talk about that, have that information available is huge. And then why is 60-40 between the two valuation methods? You said 60% one, 40% other. What was your basis for that? That's the subjectivity I was getting to.
We use the 60-40 weight mainly because we wanted the company, in our opinion, is going to be not substantially, but significantly different than it is right now, especially since they're going to recognize revenue synergies, since they're very diversified now. So we wanted to take into account like more of the potential side of it rather than relying on a fundamentals analysis which relies more on historical performance.
Speaking of fundamentals analysis, did you ever consider using an EV to EBITDA or any other type of tying the valuation into the income statement? That's pretty common out there. That's why I asked.
We thought about using things of that nature as well. One of the key problems is with the fact that this company that's going to be there does not exist yet. We have two companies, a Shaw, and then we also have CB&I.
But the history of both exists, so you
Yes.
have some ability to do that.
And one of the things that we face, being honest, is the recession side of it. So we have to account for the recession and play with the numbers and by the structures and with the operating.
But most of the
as
world
well.
still compares it to those numbers through time, and that's just something that I want to throw out.
Sure.
If I could, I did want to point out, we did have in our backup slides some of the numbers from the segment analysis. And I didn't realize, I'm sorry that I thought you all had our reports as well. But we did have that in our backup slides if you'd like to see them.
It's all good.
Okay.
I see an adjusted beta of 1.65. How did you get your beta? How did you adjust it?
We looked at several sources for our betas. We looked at Value Line. We also looked at, I believe, Yahoo Finance and Bloomberg. And there was a range of betas. And basically what we did was we looked at what they had for Shaw. We looked at what they had for CBI. And then the adjusted beta we used wasn't adjusted in the sense that it's talked about in the text that the CFA provided. But what we meant to say is that this was kind of like an average that we picked to use as a beta, considering that we had to account for both companies in our evaluation.
And I recall when talking about the beta, we play with the weights of different companies and we try to come up with the closest one. If you look at the industry, it's 1.65 and CBI is 8.65 in Value Line as well. And we try to be as conservative as we could, and the fluctuation will show a better result with that 1.65.
Once again, it would help yourself to give us more than information to know how you formed that.
Sure,
Okay.
sure.
Did you have another question?
Yeah, on your P ratio, can you talk to me about the mechanics of how you derive your $77? What PE you used and why you chose that PE, and what earnings EPS you applied to that multiple?
Right. We used our projected earnings per share. Let's see if I can get to it. These were our projected EPS for the 5 years that we used. We used a price to earn. We looked at the past PEs for the companies, and again, we had to use a little bit of guesswork and averages trying to count how CBI and Shaw are going to act together and instead of separately. We came up with we came up with these after our averages. We came up with these two ratios after doing our averages company by company, and then we weighed them like this by. I think we did a percentage of revenues.
How far back is that? Are those averages?
I think these were 3-year averages.
We used 2009 to 2012.
Yeah, we were trying to take out effects of recession.
Most people call it a PE ratio, not a PER.
So we're just trying to make it fit the arrows.
No, I understand. It's a small difference, but.
Did you take into account industry and like some comparable valuation at all? Like frequently PE will be like a comparable valuation. Did you do any comparable?
We did examine, as Chow was mentioning earlier, we did look at the competitors and their analysis, and I don't know if the information's on here, but we did look at their PEs to kind of, again, as Shelley was mentioning, kind of a sanity check to see how we were doing.
So what she's saying is, in CFA will teach you this, DCF's more of intrinsic value. Usually price per earnings, price per sales is more of a relative value. People like to see both and kind of see where the valuation shakes out. So that's what she's saying.
Yeah, right.
And then on the risk to the nuclear there is the low prices of the natural gas will not incent utilities to build nuclear facilities.
Yes,
and there's
that's
also a government risk. So you gotta kind of take that into consideration.
Yeah. Thank you.
Thank you guys. Good job.